Big tech earnings are on deck this week. We will hear from Microsoft, Google, Meta, and Amazon. They're among the names set to release their results. It'll be a big test for the market and this year's AI-fueled rally. Well, stocks already starting the week, though, under pressure as a 10-year yield briefly jumped above 5%. For more on this and the broader market landscape, we want to bring in Troy Gayeski. He's FS Investments Chief Market Strategist. Troy, it's good to see you. So already a lot to unpack, and it's still only Monday morning. We've had this massive run-up in yields, the 10-year just above 5% earlier this morning. And then, of course, this comes before the tech results later this week. How are we set up going into this week of earnings, and really what this could signal about the trading action we'll see in the coming weeks?
Yeah, so much of this has been driven by much higher yields, right? The fundamental driver, of course, is that the U.S. economy continues to be extremely robust on the consumer side in particular. Even withholding tax growth has popped back positive after contracting in Q2 and Q3. However, on the technical side, remember, there's Treasury issuance as far as the eye can see. The Fed is no longer the biggest buyer. They're the biggest seller. The Chinese and the Japanese don't have the wherewithal to buy what they used to. And then if you think about the U.S. banking system, the U.S. banking system has the capital to buy treasuries now. But after the book value destruction that happened earlier this year and late last year, there isn't a lot of impetus. So the technicals of the treasury market actually frighten us more than the fundamentals. And that clearly means another round of multiple compression and the potential for more downside pain in mega cap tech, which clearly led the rally this entire year and has been involved in the sell-off recently.
Troy, what type of risk factor do you believe that the yield environment right now, and as well, kind of combined with that, the Fed's rate hiking campaign, also puts on some of the earnings growth that investors are going to continue to look for over the course of this earnings season, and what CEOs are able to kind of dispel about the pathway forward from this point?
Yeah, so it puts even more pressure on explaining why some of these incredibly elevated multiples are justified. AI is obviously going to be a key driver of revenue growth and profit growth, but so far it's really only impacted NVIDIA. And yet we reflated back up to close to 19.5 to 19.8 times the S&P, and much, much higher in large cap tech. So our question hasn't been whether these are great companies that can grow earnings and revenue over time. It's whether they justify, or the multiple that people are paying is justified. And by June and early July, it looked like that was a dangerous assumption. But it's not all negative, right? This is a great time to be a private lender. It's the best opportunity we've seen since post-GFC, with banks retrenching and much higher yields in the front end. If you're focused on multi-strategy funds that benefit from higher risk-free and can take advantage of slower refi activity, there's still a lot of exciting opportunities. It's just in the short term, it looks like there'll continue to be technical pressure on mega cap tech. So the earnings have to be very strong, and there has to be guidance to justify the current multiple.
Yeah, and so with regard to that justification of current multiple, can you perhaps quantify the type of adjustment that needs to take place that the market should be looking for, especially considering some of the factors we just laid out?
Yeah, look, you're going to have to see solid earnings beats and guidance that gives people comfort that there'll be consistent revenue and earnings growth, even in a higher yield environment. So obviously, if there's misses, they'll be punished. If you're showing only 1 or 2% earnings growth vis-a-vis expectations going into this earnings cycle, if the 10-year was at 3.5, that would be more than enough. But in an environment where the technicals look like they could push the 10-year through 5% over the next 6 weeks, particularly into year end, you're going to need to see much stronger organic earnings growth and revenue growth than has been projected up until recently.
Troy, if we do see the yield hover right around the current levels, or potentially even trend about a little bit higher, how much pressure then are you talking about when it comes to some of these tech leaders and what we could see in terms of that downside risk?
Yeah, so it looks like the multiple bottom occurred last October, and we'd still say that's more likely than not. The issue on the top line, again, comes from, even though these are great growth industries, as recession risk has gone up meaningfully, it looks unlikely that we won't get lower lows in terms of price for this year, not as low as October. So we think somewhere between 5 and 10% more downside from here. Again, not wiping out the entire gains we've seen since last October, but certainly a significant hangover for some of the AI-fueled mania that we saw, particularly in May, June, and July, which was partially driven by extreme short covering from hedge funds that were a little too over their skis and short. So we'd be very cautious about adding into growth in the back half of the year. Wait for this yield scare to play out. And then as we get cues from the economy in terms of potentially avoiding a recession and pushing back cuts even further, that's when you probably want to get a little bit more aggressive going into early next year.
Troy, when you're talking about getting a little bit more aggressive going into next year, I guess where do you see those opportunities? And also following up on what you just said about recession, maybe being able to avoid it, what does the probability of a recession look like to you today?
Yeah, so right now we still think it's around 60% over the next 12 to 18 months. There's really a virtuous feedback loop taking place, which has lowered those recession odds. It's the virtuous feedback loop between more state and local government spending, more CapEx and business fixed investment driven by the Inflation Reduction Act, a housing market that is now a contributor to growth, not a drag. And again, the labor market continues to be remarkably tight, driven partially by hoarding. So that's really, really good news in that, ultimately we can potentially avoid recession. If you're focused on floating rate lending strategies, you have more income than expected and much less downside risk from defaults. And in terms of getting aggressive, what I meant by that is if you have a portfolio that's focused very heavily on cash and is also focused on alternatives that have less downside, particularly to this spike in yield, it certainly makes sense to continue to own large cap tech as a complement to things that can grind out more consistent returns. It's just that we've seen this cycle repeatedly is that every time there's a new technical development, whether it's short covering or a strong bear market rally, then you throw the AI mania on top. There's an over enthusiasm for overpaying for very high multiple stocks based on the 2009 to 2021 environment. And we just don't think that's coming back anytime soon. So, we think much more like mid to low high single digit returns are in order for equities going forward. Add a few hundred basis points on that for mega cap tech. And what's so interesting about this environment is you can get very similar returns in the senior part of the capital structure, whether it's in real estate or in private corporate lending, which should be competitive to equities going forward. It doesn't mean you go completely to cash or to alternatives. You use them as a complement to some of your large and mega cap tech and market weighted indices like the S&P.
Some top shelf strategy and analysis. Troy Gayeski, who is the FS Investments Chief Market Strategist, for joining us this morning here. We certainly do thank you, kicking off the week with us. Thanks.
Take care, everybody.